नमस्ते, सत श्री अकाल, आदाब। मैं हूँ आपका दोस्त आदित्य त्रिपाठी, फिर से आपके साथ एक इंटरेस्टिंग वेबिनार लेके आते हुए। For all the investors that are lined today on our YouTube and all social media platforms, welcome everyone to the webinar with Access Mutual Fund. Today's webinar is on an interesting topic, and eventually we're gonna talk about post-budget analysis. Today we have our guest, Shalini Gautam. Hi Shalini, how are you?
Hi Aditya, I'm good. How are you?
Amazing. Shalini is Vice President of Products. She helps us out with all the questions in regards to post budget, as well as much of the questions that I keep asking her in terms of mutual funds. So, Shalini, thank you for coming to the show.
My
Eventually,
pleasure.
we are glad to have you on the webinar
Thank
today.
you, Aditya.
So, the floor is yours. Please help us out, help understanding what post budget analysis or post budget outlook is all about, and how an investor can success from it.
Okay. So Aditya, let us do it this way. I have a presentation with me, a small presentation, which I can take everyone to, which basically shows what the budget is all about. And then once we're done with that, what's the outlook on the economy? And then we can take any questions that you may have.
Sure,
Yeah.
sure. Our investors are
So,
eagerly waiting for the presentation, so please go
yeah.
ahead.
So I'll just share my screen with you guys. Is my screen visible?
Yes, Shalini, it's visible.
Okay. So current view, we think that this union budget will, it was positive in the sense of boosting consumption. Whenever you see a boost to consumption, it helps improve the domestic demand and improve economic growth. So this budget is basically going to help boost economic growth without compromising on fiscal consolidation. Now, markets have been in a consolidation mode for the last 3 to 4 months, and we could see that the performance will be guided by earnings growth and valuations. In the long term, we feel that markets normally align with nominal GDP growth, and we expect this trend to persist. Markets this year, and we have been saying this for the last 3 to 4 months, they are likely to be more stock specific, and high valuation sectors may consolidate in the near term. That is, if they particularly lack any earnings growth drivers. Again, globally, if you look at the global level, we have the new president in the US and his policies, which have already started. So, any repercussions from those policies, like tariff measures recently imposed in China, Mexico, Canada, and the response of these countries to those tariffs will also hold its way. So, it is global developments are in a wait and watch mode, and they will keep unfolding as and when during the course of the year. So let's see how they go. But we think that these could be these developments in the US could also impact the equities in India. So coming specifically to the union budget, we call this budget as 3 R's, which is responsive, responsible, and reforms. Why do we call these as these three? We have seen that the budget is very responsive in with regards to the changing needs of the economy. Our consumption has been down for despite the economy doing well, consumption has been a pain point. So the government has been very responsive in boosting consumption by lowering the income tax rates. It's been very responsible in terms of its measures in bringing down fiscal consolidation, aligning it to the way it wanted it to be, and reforms, some small reforms initiated in various sectors, and also, regulatory reforms. So these are the 3 R's that we think the budget has been about. Now, if we talk about the key highlights of the budget has shifted its focus from capex to consumption. So far, in the last 2 years, we have been seeing talks about capex. Capex does boost consumption effectively, but consumption has really been a pain point, and we have been seeing consumption a very different way, where either there is a premiumization trend picking up and the rest of the economy not really picking up in terms of consumption. We expect this budget to provide a boost to consumption, which effectively would provide a boost to the faltering domestic demand and improve the economic growth. This is without being compromising on fiscal consolidation. Now, this budget was very critical in the context of the sentiments that we have seen recently. Markets have been really, in a consolidation phase in the last 3 to 4 months, and we have seen them come almost 12 to 15% of the record highs. From inflows, we have seen FPI outflows, and they have been quite, stark numbers. We've also seen how the policies of the US have been impacting the markets globally. So this budget has been very critical in that context. Now, almost for the first time in a decade, this budget was more focused on consumption and savings rather than capex. Capex has been really flat and not much importance given to capex this time. This was more like a populist budget. It has put more money in the hands of people by realigning the tax slabs. So, which is about almost adds to 1 trillion of disposable income in the hands of people, which also means 1 trillion less income for the government. It has increased allocation to rural schemes. It has enhanced the credit limit for Kisan credit farmers from 3 lakhs to 5 lakhs. So basically, this is boosting rural demand, giving them more money as such in their hands. And put together, it is a $50 billion boost to drive discretionary consumption in the coming year. Now, in terms of fiscal consolidation, we remain one of the few countries which have been reducing fiscal deficit from the post-COVID days, and this is now inching to pre-COVID levels. When we say about 4.4, we slowly, heading towards pre-COVID years. The cut in personal income tax, now individuals earning up to 12 lakhs will not be liable to pay income tax, and slabs and rates have been rationalized across the board. Consumption boost we have already spoken about. Capex thrust maintained at 3.1% of GDP. Import tariffs have been slashed across various intermediary inputs and equipments. Then the regulatory cholesterol, the regulatory burden that the government was facing in terms of ease of doing business has been enhanced. So the government has formed a committee that will bring about the ease of doing business, which is really very important because when it comes to the ease of doing business, we are always on the lower scale compared to other economies. So these are the revised slabs as such, and you can see how this has made a change. So I will just leave it up to you guys to have a look at this. But you can see on the right-hand side, how these slabs and the tax rates, the rebates come up to. So you basically get a boost of 1.1 lakh in your hand. And given the way the rates are, it will help boost savings. When obviously savings are boosted, the natural progression is it increases your consumption. And it also increases your savings because, investments in mutual funds or any other investment schemes, and in that particular sense, enhance growth. Now, these are very, slides where we talking about, sorry, just give me a minute. Can you see this? Okay, so we are talking about direct taxes, and if you see, the direct taxes have been really resilient, and they have been growing 14.4%, which is 1.5% of nominal GDP growth. Now, this has been led by a strong buoyancy in personal taxes. We see the tax rate on the personal front grow up to 20%, while corporate taxes have been moderating. Despite all this, the exchequer is bearing 13% YOY growth, year-on-year growth, and with this 1 trillion amount foregone, the direct taxes are budgeted to still grow 17%. Now we talk about fiscal consolidation. The government has been talking so much about fiscal consolidation, and it continues on the path of fiscal consolidation, bringing it down by 40 bips. And we are, as I mentioned earlier, we are one of the few countries, who have been reducing the fiscal deficit slowly, and it is now coming to pre-COVID levels. Now the government has changed the way, in this budget, the government has changed the way it will be looking at fiscal deficit. So it will now look at it in a way of attaining a debt to GDP level about 50 plus minus 1%. And the last rate was 57.1% in FY25. So you can imagine it bringing slowly down in the next 6 years to roughly around 50, 51%. Now, this is the fiscal max, just a broader overview on how the government's revenues and spending looks like. And for all of you, who have not gone through the budget, I would really urge you to go through the document, the way the government outlines its deficits, the expenditure, how it takes into account various aspects. It is pretty interesting to always know how the government is looking at the budget, what is it there, how do you read the budget, and what are the takeaways from for everyone, because everyone will have a very different takeaway on this budget. So it is always advisable to go through this budget on the website, indiabudget.gov.in, and have a reading of how it looks like. So this is basically the fiscal maths, and we are talking about in four fronts: tax revenues, non-tax revenues, expenditure, and market borrowings. So we have already spoken about the income tax rates as such, and it is bringing about 1 trillion in income tax cuts. Non-tax revenues are projected to increase to around 6.6 trillion because of the high RBI dividend. The expenditure is also growing 7.4% in FY26, and the market borrowings are 7% higher. This is a snapshot of how the government accounts for every rupee. So what this slide shows is where the rupee comes from and how is that 1 rupee spent. Now this is a breakup of 1 rupee. So income tax, whether it's personal and corporate, that forms a larger share, which is around 22 plus 17. Borrowings and GST also the main source of revenues for the government. So these are the main taxes. The direct and the indirect taxes are the main source of revenues for the government, and these are primarily spent on interest repayments, also given to states as a share of their taxes and subsidy schemes. We spoke about this. Net market borrowings are in line with the expectations as such. CAPEX. Now, we have been talking about CAPEX, that the government has not really concentrated on CAPEX, but it is concentrated mostly on consumption. So CAPEX is largely flat this year. And but if you see, when we talk it being flat, it is still on a rising mode. And if you see, this CAPEX has been slowly, inching up from these 3% levels. It is now around 11.2% levels, which shows that the government has really spent a lot in the last few years, particularly in areas of defense, roads, railways, transportation. Those are the areas, and there are a lot of subsectors within those which really get a boost out of these capex allocations. Now, road and railways have been really almost same as the last year, not really much of a change. But where the change comes in is it is spending the incremental effect is where in terms of new lines, they're doubling signaling, railways, telecoms, electrification projects, etc. And the PLI schemes, electronics and semiconductor production, are seeing a significant jump. We are talking about capex, and then we see that the corporate capex and credit is slowing down. So the slowdown has been pretty evident last year, also because of the it being an election year. Now, if we see within the private sector, we had been expecting the private sector capex to really pick up, which has not really happened. And one of the reasons is the top line of the corporates, the cash flows, the profits, they are really moderating. And this is also visible in terms of the results that we have been seeing so far. We have now had 2-3 quarters of, subpar results. And we do expect going forward the results to bottom out, the earnings growth to moderate in the next 1 or 2 quarters, and then to see a turnaround. Now, bank credit growth too has been slowing down. And if you see those levels, it has really been coming down as such from those 16 plus levels. This has been also weighing on economic growth because the corporates are not really the corporates are not really taking on a lot of credit. So capex could meaningfully slow because the government capex, if the government capex and the private capex weakens, then you are only looking at boosting consumption, but the capex has been slowing down. Now, this is a view on sectors and various categories, and we're talking about how electric vehicles can benefit. The import duty reduction will help the four-wheelers, motorcycles. Then we're also talking about FMCG and discretionary. Now, FMCG discretionary, consumer staples and consumer discretionary are the bigger beneficiaries of this consumption boost, of this, when I say consumption boost, it is because of the change in the tax rates, which will definitely boost consumption. So what really benefits consumption is various sectors such as, your discretionary spend such as autos, your travel, tourism, the hotel industry, hospitality industry. You're buying, more of cars. You are able to take a little, expand your credit lines and, invest in a real estate or something like that. So that is where the boost to consumption will come from. Obviously, when that happens, even banks become the beneficiaries. When you're taking either savings are channeled through the banks or the mutual fund industry or investments, direct equities, there are a lot of beneficiaries as such. So all those stand to benefit. Railways, defense, roads, all of these are sectors which will benefit marginally. Obviously, again, when we're talking about discretionary spends, your travel, so you're going by railway, roads, so your GST collection becomes high, your railways, when you are traveling by rail and all your, revenues increase. So those small multiplier effects that a boost in consumption can bring about. And then we're talking about healthcare. There were some benefits for the healthcare sector in terms of bringing down the prices of life-saving drugs. And also that will really help. The government is intent on boosting medical tourism. So that will also really help as such. So these are the impact, broadly the impact on the sectors. Now, I just want to take you quickly to the markets, the way they are, the valuations, how they are. In 2025, at least for the last 1 month, markets were in negative. There was only last week that the markets were sort of trying to wriggle out of that negative zone when RBI announced the liquidity measures. And otherwise, it's been a month of low returns as such. So we did, end the month negative. And the FPI sold 9 billion, and that's quite a big amount just at the beginning of the year. DI has brought in 10 billion, so which is, more than compensated for the negative outflows. Now, if you look at this, still, when we say SMID, the small and mid cap Ps are still in a little bit of the higher range. They are still not, they're still a little, again, close to their 1 SD, whereas Nifty is quite corrected. So we do think, but still, when we look at valuations, they're still high by historic standards, which means that there could be still bouts of consolidation happening. They could be intermittent. You really don't expect markets to move in a single line. And we could see some fluctuations happening every now and then. Earnings cut, we spoke about, they have been picking up, and earnings growth, at least for this quarter, is going to be weak and in mid-single digits. Now, the demand side has, been able to drive flows. If you see, the FPI, all the FII flows have been taken up by DIs. They have bought into all the outflows, and DIs have been really up. Our mutual fund investments, systematic investment flows have been really consistent. And hats off to you guys. It's very important that when markets correct, to stay invested, to be a part of this India story, because, just the way markets do not go up in a straight line, they will not also fall in a straight line. So always, patience really pays, whether it is on the upside or the downside. Patience and staying invested really pays. Now, FI flows have been sharply negative in the face of rising supply. We have seen that, a lot of IPOs have been out, private equities have been trying to, the promoters have been trying to cut down their stake, taking advantage of the market valuations. So that is also one of the reasons where there's abundant liquidity in the market. Now, what can drive Indian equities in 2025 is, we have been talking about, this is a year of stock picking, and this could be across market caps. It is not that it's only about your large caps, but also about your small and mid caps. There could be opportunities everywhere across the curve. And, it is really a year of stock picking. So please do stay invested in the markets. This is broadly what it is about. Why should you stay invested? And what are the sectors that we like? We have been talking about a few key themes such as IT, pharma, quick commerce, capital markets, travel tourism, renewable capex, power transmission, EMS, defense, and automobiles. And broadly, if you see that these are the sectors which are the beneficiaries of the consumption boost, which will be the likely beneficiaries of the consumption boost. Some key risks to to be aware of and to be in the know of is slowing global growth and developments in the US. We have our geopolitical conflicts, which bring about certain stresses in the market. Any tariff measures imposed by the US and their impacts, counter impact by the other countries on which they have been imposed. Geopolitical risk leading to import inflation and a weaker currency. So when the currency weakens, there also brings about a lot of risks and relatively higher valuations in India. Now, this is just a backdrop about the economy, and we are one of the fastest growing economies still. I will just try and quickly rush through this so that you guys have more of bandwidth or more of time to ask me questions. India has huge scope for growth, and our GDP has been at an inflection point. 2000 per capita income is traditionally seen as an inflection point, and this is when we say that the basic needs are met, and the country wants the disposable income rises. China reached this point in 2006, but while its GDP capita rose, equities has not reflected the same growth, and it's remained flat. Whereas, while a per capita GDP is still lesser than China, at least we have gained in the last decade because of regulatory reforms. We have a strong framework, an open architecture, and we have access to various investment avenues. We are in a better shape compared to most of the emerging market countries. Our domestic factors have been on a strong footing. Lower fiscal deficit, our tax to GDP has been rising. Corporate leverage is low. Banking NPAs have been trending down. Although external factors have been weakening from higher, forex reserves are down. Our currency has been depreciating, and our import cover has come down. Now, we have been in a capex upcycle. We talk about capex not really picking up this year, but if we talk in the, we look back at the last few years, you'll see that the capex cycle has really, picked up, and it has doubled in the last 5 to 7 years. And that is how we should look at it broadly. 1 year does not make much of a big impact when we are looking at a long-term growth story. Definitely our improving infrastructure. This is, how we were in the last 10 years. And if you see, there have been a lot of changes. Solar power capacity, broadband subscribers, number of airports. Even in the budget, the government has been talking about increasing more airports, number of airports in the UDAN scheme. So this is about improving infrastructure, digital infrastructure, and we all have been the beneficiary. We all have seen how digital infrastructure has made a change in our lives. Now, themes driving up portfolios are the IT, pharma, quick commerce, capital market, travel, tourism, renewable capex. Now you'll see these are mostly the themes that will also be receiving a boost from the budget. So these have been the themes, and I will really, just run through these. We expect IT to recover this year. Pharmaceuticals has been going strong, and we expect much stronger growth this year. Quick commerce is in a hyper growth phase, and this is one story that we all resonate with. We all have been, using quick commerce in every aspect, and we have seen how it has really benefited. Capital markets to further benefit from retail participation, and this is across various segments, which is whether it's the asset management companies, it's the exchanges, it's the brokers, wealth managers, other intermediaries, all are benefiting from this huge jump in, this broad participation in capital markets. We're also seeing a rising number of demat accounts, which really denotes how, the retail participation has been increasing. Travel tourism, I think we all really love to travel. And this is one key aspect, which has really, changed. And you yourself would have seen, how travel and tourism has been changing in the last 10 years, where, the prices have really been going up for whether it's the airlines or the hotels. We all see, that the rates have been rising. Still, people love to travel, and this will always be there as more and more people come into the, working mode, and we are a very relatively young country. So this is one sector which is really going to be benefiting from, at least for this year. Power sector capex to pick up with the decarbonization push. Again, defense has been one, a key pivotal area for the government, and its outlay every year inches up, and this is one segment which really gains from the government's push. Automobiles, yes, we all have seen how, we want to upgrade ourselves, whether in terms of two wheelers, SUVs, even the rural segment wants to upgrade themselves from um, two wheelers to passenger vehicles, or there are more people falling under the net of two wheelers and tractors. So these are some data points as such. Preference for premium bikes. How do we identify companies? We identify winners based on the business strategy and prospects, the industry traits, management team, balance sheet. Now, this is something which we really talk about all the time. And I'm sure that you guys are also aware of how we look at our companies. So I will not really go much through it. And Aditya, over to you. This was a quick run of how the budget was and how the markets look currently.
Uh, Thanks, Shalini. Thanks for all the insights. Eventually, there are a few questions from the viewers and investors on our YouTube channel as well as all the social media. So
Okay.
this is one of the question from. Okay, this is from Ravi. The question is: which sector are likely to benefit the most from the budget announcement, and how can mutual fund investors gain exposure to these sectors?
Okay. So one, I would first, tell investors, budgets come and go every year. And when you are talking about investing in mutual funds or investing in the markets and through direct equities, you should always look at a long-term approach, which means that you have an asset allocation plan ready. You are investing across the curve, which is with a large, small, mid, thematic funds, passive funds. It's not only about active but also passive funds, based on your investment horizon, your risk profile, and your investment goals. So budgets will definitely give a boost. This budget will have definitely given a boost, and you should be investing, but you should also look at it in totality. Do not just go by sectors as such. That, today the government has brought out about a budget, and I should only invest in these sectors. Most of the mutual funds are tilted towards both capex and consumption-oriented sectors. So investing in a mutual fund would anyways be beneficial for you if you invest in those funds. Now, coming to which sectors, really, I have already walked you through what we think in terms of our sectors, which is the consumer discretionary. And consumer discretionary also has a multiplier effect on various aspects of the economy. So when we're talking about this consumption boost, and people who are the beneficiaries of this consumption boost will be the people who fall under those 12 lakhs bracket. So which means it is about people who want to upgrade to something like, say, for instance, the people, who want to buy air conditioners, or, who want to buy vehicles, a passenger vehicle or something like that. So that also receives a boost, but it is about travel tourism. It is about consumer discretionary. It is also about upscaling or upgrading your lifestyle at various levels. So those are the sectors, but particularly the consumption discretionary, which also includes the automobiles, the travel tourism industry. You have the capital market segment. You have, when you're investing savings, you're channelizing the savings. The banks also become the beneficiaries, because with a little boost in disposable incomes, you also tend to take up a little more credit to upgrade yourself. So even banks are the beneficiaries. So these are the sectors, one of the sectors that will be the beneficiaries of this budget.
Okay. This question is from Dinesh Madan. Can you share few insights on outlook for Indian economy and how long the correction will last?
Good question. Now the correction, how long the correction will last is not really something that we can, pinpoint and say only till this year, this month or next month. The run-up has been very sharp also. This was the 2024 was the 8th year, if I'm not mistaken, of positive returns for Indian equities, which means we may be seeing volatility in the markets, but overall on a calendar year basis, that was 2024 was the 8th year of positive returns, which means we have seen that growth. Now, markets will never move in one direction. They will not always go up. There are always phases of declines. There are always phases of volatility because there are also a lot of people who will take profits. There are a lot of FPIs who will take profits, and high valuations cannot be sustained forever. So markets were to come down because of these higher valuations also. How long will this correction last is, difficult to pinpoint really. But we say this is a year of two halves. And once you see a turnaround in the earnings growth drivers, we see some bit of improvement in consumption. You will see the markets also turning around. When your consumption improves, the companies in the consumption space also the beneficiaries, and their top line also improves. So then that multiplier effect takes shape. On a long-term basis, Indian economy still remains on a firm footing. We are not looking at the economy only for a period of 1 year, but always look at any, when you're looking at investing, please look at it 5 to 7 to 10 years plus phase as such, is what I would say.
Shalini, a lot of young investors, or I would complete with the terminology called Gen Zs,
Mhm.
eventually are going to graduate and are going to start their job or start their career in multiple fields. And probably when I was hearing the budget, I was hearing the fact that uh, tax below 12 lakhs is not going to be applicable to much of
Hmm.
segments. So, is this a good time for them to enter the mutual fund space and start investing?
Um, it's definitely a good time, and any time is a good time for anyone to enter the mutual fund space when you want to save money, when you want to invest systematically. Now, so for instance, let me tell you, I mean, we all have seen the euphoria around equities, the investing directly in equities. Not a bad choice, not a bad option at all. If you know that you are there in it for the long term, when you are there to just make, small gains or, trade equities, as a trader, that is where the problem starts because not everyone will make money out of it. When we're talking about investing, we are looking at a point of value creation, wealth creation, sorry. So when you're creating wealth, wealth creation does not happen in 1 or 2 or 3 years. It takes a long time for the wealth to create and multiply. If I was to give my example, Aditya, now I have been investing in in mutual funds for the last 15 years or so. And I have seen markets move from a point of, say, 5,000 to 8,000 to 10,000 to as such. Now, if I was to look at it on a year to year basis, I would have not made that wealth creation, which I can, say that I have saved for the last few years. So from 5,000 to 25,000 is a long process. And that is how one should be investing in equities. Do not look at it for, say, 2 years or 3 years. Definitely, we have been lucky that post-COVID markets really, gave us good returns. But this is not the way markets will always work, And so just be mindful that you have to invest for the long term. Just have that patience, till the time you don't need the money to apply for any of your goals. Just keep your money invested. Now, whether you are participating in equities directly or through mutual funds and investing in equity, passive, debt funds, I would say, have a comprehensive asset allocation approach and a disciplined approach to investing.
So people who are more prior investing in equity or are investing more in equity as compared to debt,
Hmm.
is this budget going to be good for them, or it's vice versa, or it can be on the both ends?
So I would say that people who invest in debt there will always be certain portion of people who want to invest in debt. There'll be always certain portion who want to invest in equities, and there will be a mix of both. Now, it really depends on how you see yourself, whether you have the risk appetite or not. But if you're in a very, in a phase of your life where you're happy to take on more risk, you should always take on a little more risk because it helps you in that wealth creation as such. Debt is good, definitely. It helps you balance the fluctuations in the markets as such. So when you don't know where the markets are headed, you can definitely be invested in it. Personally, as a person, I love to invest in equity mutual funds. And I think that, you can tilt also because the markets have consolidated. You can tilt your portfolios a bit more in favor of equities. Having said that, we are also expecting this year is going to be good for debt investors. Once we see the interest rates coming down, that is when the debt funds will begin to, show a larger amount of a little more returns than they are currently. So this year could be a year for both as such, but for equity investors, just be a little more patient. Aditya, I want to ask you one question. You have been asking me questions. You are Gen Z, I assume. How do you see this budget? How do you go about investing?
There are few things I was thinking from my perspective. So I have been more of a passive investor, investing in passive funds, investing in indexes, which are not more allocated by the fund managers eventually, but more on the index side of it. But after looking at the budget, I feel like that now I'll be opening my books from my end, eventually more in index funds, something more in equity funds, something like multi-cap, where I'll have the mixture of all the three particularly. And yeah, I am still above the tax slab. So yeah, saving tax through ELSS funds is also particular in my mind. But that's the entire brief. That for me, it's been a good post budget year segmentation. For me, the tax regime seems quite viable to enter the market and invest more and more and make wealth for myself.
Okay, cool. So that's how Gen Z should also be looking at. But I would also tell you, Aditya, it's passive investing is good, and even I do passive investing, but have a mix of both active and passive as such, and that really helps you boost your returns, and it also gives you a perspective as to how markets are, what should your expectations be as such, and definitely, this is how Gen Z should look. You said you will be investing in multi-cap. You can also look at balance funds as such. When we're talking about equities versus debt, balance funds is also the way to go with it. Hybrid funds are always also good to have in your portfolio.
Suggest any few if you can, please. That would.
Um, okay, no names, please.
But yeah, that was in my mind
Yeah,
eventually.
yeah, yeah. Okay.
So I thought maybe now it's time. So I wanted to allocate my asset more into the equity side because
Mhm,
it's been 3 to 4 years I've been investing in on the passive side, doing
mhm.
SIP, making some lump sum investments around,
Okay.
and few investments in crypto, which I understood that it's much better to invest in mutual funds than
Well,
investing in
you have
crypto.
made your money already, Aditya.
So, Shalini, I think just a second. Let me see if there's any more questions around or from the thing. Okay. Himanshu has a question is how are fund managers likely to adapt their investment strategies in response to the budget and its implication for the economy and market?
So, see, I just shared my presentation with you guys, which is we were already ahead of the budget, and our portfolios were also tilted towards consumption and capex both. Any economy will not run only on consumption. It definitely needs to have a mix. So we talk about consumption and capex as a theme, and that is how our portfolio tilted. Anyways, so we already had those stocks, perhaps, and it is too early to adapt to anything, but that is how the fund managers will look at it. And as I said earlier, uh, budgets come and go, elections also come and go, and such. But always look at a long-term approach as an investor.
Thank you, Shalini, for an amazing insight on our post-budget outlook. It was nice meeting you. So, all the investors that are tuned into our social media platform, thank you for joining in. You have been a lovely audience. For more information, log on to www.accessmf.com where you can invest, or you can also download our app from Play Store and App Store, both where you just need to type Access Mutual Fund. Thank you. We'll be coming up with such webinars on weekly basis. So that's all. Thank you, Shalini, for sharing your
Thank you,
insight.
Aditya, and thank you, investors. Happy investing.
Happy investing.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.